Hello everyone, and welcome back to the channel where we decode the most intriguing dynamics of the stock market. Today, we're diving deep into a specific stock that has triggered our hard-to-borrow screener with some truly eye-popping metrics. Zhongzhou Inc., ticker ZCMD. We'll explore why this microcap healthcare stock is catching attention, what hard-to-borrow actually means, and the mechanics behind a potential short squeeze. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. ZCMD logo/name Zhongzhou Inc., or ZCMD, operates in the healthcare and health information services sector within the People's Republic of China. Show sector graphic. They provide vital healthcare information, education, and training services to medical professionals under their own DMUG brand. The company operates through two segments, and DMUG services and sales of patented drugs. With a tiny market capitalization of just $1.07 million, ZCMD is firmly in the microcap category. Show current price chart. Looking at recent price action, ZCMD has seen significant declines. Today, it's down 25.62%. Over the last 5 days, it's dropped 31.36% and an astonishing 90.28% in the last 30 days. Volume has also been very light, with today's volume at 338,800 shares, a mere 0.1% of its 30-day average of 3,719,804 shares. So, why is this stock on our radar despite such bearish momentum? It's all about its hard-to-borrow status. What is cost to borrow and why it matters? Animate CTB explanation. When you want to short a stock, you essentially borrow shares from a broker and sell them, hoping to buy them back later at a low price and pocket the difference. But borrowing shares isn't free. You pay a fee, known as the cost to borrow, or CTB. This is an annualized percentage rate. When a stock CTB starts to skyrocket, it signals that there's extremely high demand to short the stock, coupled with very limited shares available to borrow. This fee can even exceed 100% annualized, meaning that simply holding a short position for a year could cost you more than the value of the shares themselves. It's a key indicator of market sentiment and supply dynamics for short sellers. Why this stock is hard to borrow right now. Now let's look at ZCMD specifically. Show key stats on screen. Currently, the annualized cost to borrow fee for ZCMD stands at an astounding 920.9%. To put that in perspective, that's nearly 10 times the value of the shares just to borrow them for a year. What's more, the CTB has seen incredible momentum, increasing by 785 percentage points over the last 5 trading days. This isn't a gradual climb, it's a parabolic spike in borrowing costs. The scarcity is real. There are only 15,000 shares currently available to borrow, against an estimated float of 1.1 million shares. Our internal composite squeeze score, which factors in CTB, its momentum, borrow supply, float size, and price action, gives ZCMD a score of 69.5. This cocktail of high borrowing costs, rapidly increasing fees, and extremely limited borrowable shares points to a classic hard-to-borrow setup. Squeeze mechanics explained. Animate squeeze mechanics. So, what happens when a stock is hard to borrow and the CTB is through the roof? This is where the concept of a short squeeze comes into play. If the price of a heavily shorted, hard-to-borrow stock starts to move upwards, the short sellers face increasing losses on their positions, compounded by these exorbitant daily borrowing fees. This financial pressure can force them to cover their shorts, meaning they have to buy back the shares they initially borrowed and sold. Because there are so few shares available to borrow for ZCMD, just 15,000, even a modest wave of buying to cover shorts could quickly exhaust the available supply. This forced buying creates upward pressure on the stock price, which in turn can trigger more short sellers to cover, leading to a cascading effect or a squeeze. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have incredibly strong conviction that the stock price will continue to fall, and they are willing to pay a premium to maintain their short positions. Dilution risk check. Showing no dilution risk graphic. A critical factor to consider in any short squeeze thesis is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This influx of new shares can provide short sellers with an easy way to cover their positions or even encourage new short interest, effectively neutralizing or negating a potential squeeze, regardless of how high the cost to borrow might be. For ZCMD, our check for recent dilutive SEC filings like -1s, -3s, or 424 BS in the last 90 days found no such filings. This is a positive sign for any potential squeeze scenario, as it suggests no immediate large-scale dilution from the company itself. Recent reverse split watch. Another important piece of the puzzle for ZCMD is its recent reverse stock split. Joe Reverse Split Info ZCMD executed a 1-for-3 reverse stock split on June 29, which was just 14 days ago. A reverse split reduces the number of outstanding shares and proportionally increases the share price. For example, if you had 3 shares at $1 each, after a 1-for-3 split, you'd have 1 share at $3. This reduces the float, which can sometimes amplify volatility. Historically, many microcap stocks, especially those that have recently undergone a reverse split, tend to see renewed volatility or even a price pop within about a month after the split date. This is a pattern observed in some specific microcap names, not a guaranteed outcome or a rule. It simply means the stock might enter a period of increased price swings. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, if you're watching ZCMD, what should you keep an eye on? Sure checklists continue to monitor the cost to borrow rate. Any further increases or continued high levels are significant. Watch the shares available to borrow. If that 15,000 number shrinks further, it intensifies the pressure. Look for any significant increase in trading volume, especially if it's accompanied by a reversal in price momentum. And of course, always be aware of any news or announcements from Zhongqiao Inc. itself. It's a dynamic situation, and careful observation of these metrics is key. ZCMD presents a fascinating case study in the world of hard-to-borrow stocks. With its extremely high and rapidly increasing cost to borrow, coupled with a severely limited supply of shares available to short and a recent reverse split, it certainly fits the profile of a stock to watch for potential squeeze dynamics. Remember, high borrowing costs are just one piece of the puzzle and do not guarantee any specific price action. This is purely for educational purposes to illustrate how these market mechanics work. If you found this breakdown insightful, please hit that like button and subscribe for more in-depth analyses, and let us know in the comments what stocks you'd like us to look at next. Thanks for watching, and we'll see you in the next video.